So congrats everyone for staying the course. It's been an amazing day, a very long day. You all deserve a medal. So the focus of this panel really is reflection and I guess predictions, looking forward. So, putting the last few years into context and then thinking a little bit about, what might be coming next, what you're all excited and optimistic for. So perhaps just to kick it off, as normal, a round of introductions and a description of your firm's strategies in the crypto space.
Awesome. Yeah, my name is Aleksander. I'm an investment partner at CMT Digital. We're based out of Chicago, but have offices in London and Frankfurt as well. We focus kind of on pre-seed, seed, early stage crypto, and we invest across the space. So we look at kind of centralized finance companies, infrastructure. We do on-chain DeFi protocols and support there. And then a heavy focus kind of on consumer-oriented projects. So looking at the gaming and NFT space as well.
Richard Kim, I'm a GP at Galaxy Interactive. We currently manage 3 funds with over 800 million of AUM. Sector focused on the interactive entertainment ecosystem with the heavy concentration in game studios and the technology supporting the space.
Andre, partner with Excel, the global venture capital firm supporting founders from idea stage to IPO. We're investing out of our teams in Palo Alto, London, and Bangalore. Within crypto, we've been very active across software, gaming, and infrastructure more broadly.
Hey, I'm Eddie Larsen. I'm a software engineer, former captain of the Washington University and St. Louis StarCraft II team. And I'm also the head of engineering at A16Z Crypto.
Awesome. Perhaps we start with putting this cycle into context against perhaps some of the other cycles we've seen, 17, 18, things like that. Perhaps, Richard, you could give us your thoughts on it. What's the same, what rhymes, what feels very different this time around?
Yeah, I mean, there's just, the grief is the #1 word I just hear this week. It's bad. And, my personal view, I was tracking the saga in real time, and I was shocked that they commingled assets on the exchange. Like, I think people who've been in the space kind of expected Alameda to have issues with leverage and whatever, but I think the base case viewpoint was the exchange, being the crown jewels, would be segregated and unaffected throughout, and that was obviously not the case. I started my career in 2007 as a derivatives lawyer, working at Clary Gottlieb, and one of the first things I did was for Goldman to analyze the insolvency consequences of putting Morgan Stanley in default, which thankfully they never did. But it's very much a similar kind of market structure as it exists in crypto today, which is a bunch of bilateral counterparties trading with each other with no segregated initial margin in a world where perception can very quickly become reality. And that's a very scary place to be. So I think we are going to see pretty fundamental evolution of market structure. My personal view is I think crypto is going to start looking a lot more like FX, actually, which is execution and clearance and settlement and custody all being segregated, and kind of multiple providers coming in to compete for best execution across multiple parts of the stack, which I do think is going to drive not necessarily DeFi, which is what a lot of people think is going to happen. I think DeFi will continue to grow, to be clear. But I think it's going to be an even further centralization, actually, of aspects in the ecosystem into the traditional financial institutions. I was just yesterday in London speaking at the Goldman Web3 conference, and they've onboarded more people in the last week than I think in the last, I forgot what it was, last several months or year, right? Which makes total sense as a switch in credit intermediation when folks like Genesis halt withdrawals.
Yeah, if I may add, the sheer scale, opacity, leverage, interconnectedness of what's happening right now is on a totally different level than what we experienced in 17, 18. Back then, there were quite a few isolated ICO rug pulls, but nowhere near the large CeFi institutions we have today, who confer an air of credibility, but in reality they're they have bilateral relationships, and we've seen that with Celsius and FTX and Alameda. So it's pretty hard to untangle everything and to understand kind of what the exact exposure is. Also, I find this series of events this year is impacting probably much wider population, both across end consumers as well as institutions. So I think it's probably going to take a bit longer for us to really assess the full impact.
What were some of the more positive themes, developments, innovations that we've seen in the crypto space over the last couple of years? What areas do you all feel hit product market fit to an extent, or where the most innovation happened on the technological side?
Yeah, I think that's a pretty clear difference from 17, 18 to now is there's been real world use cases and product market fit across. One of the clearest ones I think is in the payments. It's still super early, but I mean, Apple announced integration with USDC today, but there's a company called Xample in Southeast Asia, right? And they're doing cross-border instantaneous payments settled in fiat with a 2% fee. So it's more efficient and more cost-effective than MasterCard or Visa, and kind of breaking up that duopoly on that front. So I think that's one area where there's been pretty promising initial product market fit. And then obviously, as Richard talked earlier on the generative art side and looking at the collectible side, and I think we're in the early innings of seeing loyalty rewards programs, Starbucks, Nike, and engaging and kind of creating a two-way street with their consumers versus just kind of a one-way direction of capital.
I think the thing I'm going to be looking for is what I call warm crypto, which is this term I came up with actually in Oaxaca. In this 24-hour dance festival called Mezcal Amares, and I met this guy who claimed to know Satoshi. I actually believe him because he was that nutty, and he was like, the problem with crypto is its temperature. And I was like, what are you talking about? And he's like, it's too cold. And I thought about that all night, and I was like, man, this guy's right? Because this space has grown on trustlessness as a primitive, right, over the last 10 years. And I think that's a really necessary condition if what you're trying to do is build a building block for a new financial system, right? But that's done now, right? And so in the context of where do we go from here, I think the idea of crypto as an incentive layer for communities to come together without having immediate access to things like liquidity, Uniswap pools, all of this stuff that potentially puts your extrinsic motivators in conflict with the intrinsic reasons why communities sustain over time. I think that's something a lot more projects need to think about through things like delayed vesting schedules and kind of new forms of value that are not expressly financial in nature. So as an investor, that poses an interesting challenge of, wait, how is that investable then? I think ultimately this is a pretty controversial viewpoint amongst crypto investors, I think, but I think the right model is to invest in the equity of companies using tokens and NFTs as a user acquisition, engagement, and retention vehicle where you have light market dynamics, allow the market to put a price on these things and benefit on the back end from kind of more consumer engagement and a more sustainable ecosystem, as opposed to promising the world in a speculative hype cycle and establishing something unsustainable.
On the more technical side, Eddie, what have you been most excited by in this cycle? So not looking forward, but what are the most important things that have been laid down foundationally?
Yeah, I think it's interesting because we kind of forget how short it's been since, for example, the first optimistic rollup started getting tested on L1. And they're starting to work. If you look at the graph of how much block space on Ethereum is being consumed now by rollups, that is this almost perfectly steady line up. It's just hit about 3%, right? Very, very steady growth since the beginning of this year. I think it's become proven that block space is valuable, and the methods of scaling it look like they're beginning to mature. ZK rollups are coming online. We even hear conversation about L3s, right? Like the infinitely sort of recursive uses of a shared data availability layer. I think that offers finally a little bit of space to take advantage of all these ideas. I don't know about you guys, but I hear far more ideas than makes sense with the throughput capacity we currently have. So I'm really excited to see how those play out. Hopefully they play out in terms of people being very clever about taking advantage of the programmability of these types of assets, right? I want to see, for example, remember it took about 2 years between the first tokens, like first ERC20 tokens, and the beginning of DeFi, right? It took a little over 2 years for that. It takes about that long to go from having a programmable interface to having very interesting applications of things that use that interface. I expect that to happen for NFTs. I expect that to happen for on-chain games, like we talked earlier about fully on-chain games. It's just something you have to wait for it to unfold. So I'm more convinced than ever that we're starting to see it.
And maybe perhaps building a bit on that technology point, what's also been really exciting to see is kind of the enabling set of tooling that's allowing developers to build on the blockchain, as well as game creators to build games. Now I find, in the early days you would have folks kind of building all these layers from the ground up, and now I think we've managed to do a good job to abstract some of the complexity in the background, whether it's accessing nodes or estimating gas fees, monitoring, whatever you want to put in production. So whether it's tools like Tenderly or others, I think there's more developers can use, and I can see a broader mass adoption of Web3 development going forward.
And staying with you, Andre, maybe just to talk about talent. So you obviously invest across a range of different industries, sectors, Web 2, Web 3. Do you look for a different type of founder on the Web 3 side? Are you looking for something different in their temperament or their mission, things like that? Or are they just entrepreneurs all the same? And
all right, it's interesting. Well, that's probably evolved. If I think of the folks we backed maybe 2 or 3 years ago, they used to be founders with a lot of grit who survived the tough bear markets, and I have a lot of respect and admiration for folks who built in the absence of the limelight when things weren't obvious. So that was probably one archetype. More recent archetype we're seeing, especially in the last few months, is strong product people, strong engineering folks coming from very quality engineering organizations, whether it's like Stripe or Coinbase or Monzo or Revolut. And I think they bring a fresh perspective to Web3 development, especially around fintech applications and payments. And I think that's needed, as there's a whole part of Web3 that kind of lends itself to more Web3 natives. But especially as we think about gaming or payments, it's actually helpful to have experienced talent coming from the outside.
What themes do we think were all massively overhyped this last cycle, and what were some of perhaps the mental models that we brought into the space as VCs from, let's say, prior markets that actually turned out to be wrong?
I think the most treacherous one is the difference between being a crypto trader versus investor. I think a lot of VC activity was driven by crypto VCs confusing themselves for options traders. Like essentially buying an asset irrespective of what it was, basically as a vol product and a discount to spot. And I think in retrospect, the model of, as has been revealed with stuff like Serum and all the FTX, all the SAM coins, is like the model of really constrict supply, have a crazy FDV, start this speculative frenzy. I was reading one of his offerings, I think it was Serum, like every investor got a higher price. So it really, so it really emphasized speed as opposed to diligence. So I think a lot of that stuff is what's relevant if you're trading, right? It's not what's relevant if you're investing. You need to convince yourself that the ecosystem you're investing in is going to be stronger in 5 to 10 years, not non-existent in 5 to 10 years. And so I think all that stuff were the kind of obvious lessons learned. And also, lastly, the difference between equity interest versus token interest, right? I think a lot of token holders, particularly for things like game studios, it's very treacherous to have raised seed and Series A rounds on the equity side and then sell tokens to a completely different set of investors because of a structural conflict of interest between those receiving fiat-based microtransaction revenues, i.e. the equity holders, versus the token holders who succeed in the event of a parallel economy where you can use that virtual currency. But what you find for usability reasons is 99% of games don't only allow you to use that virtual currency, they also have the fiat flow, right? So that's just a very unhealthy conflict that I'm excited to see go away in the market personally, and have the interest of equity holders and token holders for game economies at least be more aligned.
Yeah, and I think on top of that, prior to May, you saw like an urgency to launch a token without any actual real use case or demand side. So teams raised 90 to 100 million, had this token out there. Was it a governance token? Was it a utility token? If it's a utility, where was the demand for it? And I think, especially in the space, you just had a group of individuals who were very net extractive within token ecosystems. So specifically, like kind of looking at like the play to earn space, right? They'd have a live token with maybe like a gamified DeFi project with no actual game underlying it. And so there's no net value coming into it to balance kind of the extractive side of it. And you had a lot of that. And I mean, it generated a ton of money for teams, right? There was, I think the highest was like Guild launched and raised 110 million. Another one launched 80. Games launched 40. So there's a very clear monetary incentive to go launch the token. But now, 12, 18 months, as the tokens have kind of spiraled downward, you have to deal with the outcome of having that and that being associated with your project and how you drive value to that over the next 3 to 5 years.
Yep, perhaps controversial, but I think also an issue with some companies has been the lack of governance. Like in the spirit of decentralization, many financing rounds have been huge party rounds, more with folks kind of with a trader mindset being kind of a few steps removed. And I think especially in some of these bad situations, it shows that the absence of a board or the absence of a strong mentor who's like, fully aligned with you sets you on the wrong path.
Yeah. And on that, like with the token front, if you invest in a token, you have no governance rights or any legal rights to the equity of the company. And that really construes it when there's an equity investor and a token investor, their values are not aligned in the slightest.
What do you think the next sort of positive catalysts for this market? Is it a macro trend? Is it something more technological?
I think it's going to be the complete inability of a lot of the teams that raise to find follow-on financing, and therefore either...
That's a positive trend.
It's positive in an evolutionary sense of the term, because there's going to be a focus on kind of real businesses that generate real cash flows, or just redirecting talented people to more productive uses.
I think a big catalyst as well will be onboarding individuals without actually having them know that they're onboarding to crypto. So looking at something like Reddit for like mass adoption purposes, right? I think if you take the numbers for what they are, Reddit onboarded more people than wallets that have unique wallets that have interacted with OpenSea. If you look into like Starbucks, right? They've been the gold standard for the loyalty program and gamification of their rewards program, and they also act as one of the biggest banks with like $2 billion on that app or plus. So if you look at them roll it out, the way they've talked about it, they never mention NFT, talk about Polygon being the underlying infrastructure provider, but it's all about kind of the journey and keep it in very layman's terms. So if they roll out and kind of crush it, that's going to open up a lot of ears on the consumer and marketing and branding side.
From a kind of evaluation perspective, I think this time around we just saw this insane divergence between Web 2 valuations, Web 3 valuations, token valuations. Do we think in the next cycle that these sorts of things are going to start to converge? Are there going to be more fundamental ways that we're going to be evaluating tokens and equity in Web 3? Maybe Andre?
Well, most of our investments have been equity-based, and I would say there, at least from the data points we have, valuations have started to converge, but others may have different views.
Yeah, I think playing on a little bit of what was mentioned earlier, I think the market is learning and entrepreneurs are learning how to think about what a token is. it needs to represent something specific. Token is an overloaded word, right? You gestured at utility token and whatever. I don't even know what those words mean. Like what they really mean is, what does the token allow you to control? The whole purpose of a blockchain is that you can create a special kind of computer that can enforce rules autonomously. Well, what are the rules? What are the things, what are the principles of this token? What specifically do they allow you to control? I think it's an entirely different thing to compare a token that's kind of like an arcade token for a game versus a token that represents some kind of democratic control of a protocol, or the right to upgrade it, or the right to its cash flows, or something like that. Right? There's a massive design space. The way they should be valued should be proportionate to the story of the thing that they control. We just haven't quite refined the language yet. So I think a catalyst for me is to consider how the culture and how the zeitgeist adapts to new terminology and new technology. I think as the story becomes clearer, like, downstream effects are that we can think more saliently about valuation and things like that.
What are some of the trends looking forward that you are all most excited about?
Yeah, on our end, one area that we're looking at actively right now, and we've seen probably some of the best fundamental use cases of cryptos in emerging markets. So looking at Africa, LATAM, Southeast Asia, I'm looking at the ability to access financial institutions. I think in developed countries, especially in the US, we take a lot of things for granted, banking, access to Venmo, things like that, or access to getting a loan. But in a lot of emerging markets, that's not there. And then someone mentioned in an earlier talk, like looking at Argentina, right? The demand in Argentina has been pretty significant just because they have hyperinflation, right? So just being able to pay in USDC and spend that as well solves a lot of issues. So I think that on kind of the financial and fundamental use case of crypto will be pretty large, and we'll see a higher adoption in emerging markets over the next 12 to 24 months, in my opinion.
Two for me, fully on-chain games, which I already talked about, so I'll spare you, but it's a super exciting topic that I think is really, really interesting, and I think is a proving grounds for all kinds of interesting topics in crypto. Another one is that I think the cat is out of the bag with regard to creators disintermediating themselves from the markets and getting direct access to royalties. There's some really interesting debates on crypto Twitter recently, right, about what ought to happen with royalties. They're difficult to enforce on chain. I'm not going to get into the details of it, but the point is that creators of all kinds of different media know that there is a channel where they can get direct access to their consumers, and that there's a whole design space to explore about how they can monetize their work. We're at the very earliest stages of it. I don't think that anybody actually has the answer for exactly how it'll play out, but it's a really, really interesting set of themes that are unique to crypto, that it has to be solved within a crypto context. So
I think just on that theme, a lot of what NFTs have been to date has been about how do creators and artists monetize their works and leverage fan bases better using some of these primitives. I think the next evolution of that is how does that become a multiplayer game in terms of how do you go from creators to communities generating GDP? Because I think the ability to find your tribe at global scale for whatever passion you're interested in is something that along the lines of Balaji's network state, which you were talking about in the last panel, I think that's one of the coolest upside use cases of crypto, and one that actually resonates with what we're all looking for as individuals, at a very primal level. So there's going to be a lot of experimentation in that space, and the extent to which communities can, like I say, generate GDP as opposed to just spending with one pocket and putting it into the other, I think is going to be a really interesting thing to look at.
Yeah. And I guess keeping with that community angle, for too many large tech platforms these days, the consumers have become the product, and I'm very excited about having some value accrue to the end users, and whether that's done via token or a different mechanism for these folks to have a say in roadmap or governance, or to have some sort of economic interest. I think that can be very exciting.
Yeah, and within like Web2 creator economy today, it's so fragmented and these big platforms control all the data. So if you go viral on TikTok, converting that user base to YouTube where the monetization is higher, to Instagram, it's virtually impossible and you have to curate your content across. I think Web3 provides a really awesome opportunity to up-level that and allow creators to engage directly with their community and develop that and not be reliant on all these big social platforms that they are today.
Great. So thank you very much, guys. Just given the all-star panel we have, we want to shift now to sort of audience questions and try and spend the rest of the time we have on those.
Hi, I just wanted to ask we'll do a little temperature check, basically, in terms of, this time a year ago, what you were seeing in terms of valuations, how that's come down, also in terms of deal flow, how that's come down. And then, one of the points regarding follow-on funding or not follow-on funding, how are you determining, like, the criteria for when to provide follow-on funding for your companies?
I guess I can go a bit on the valuations. I think they're down pretty significantly, and I think over the next month or two, you'll see them come down even further. There was from what we saw, a lot of growth stage deals over the last 6 months have kind of been paused, or there hasn't been that much funding kind of at the Series C, D level. But the downfall effect of that is a lot of the later stage companies have gone earlier stage. So there's still been a pretty good amount of capital being deployed at the pre-seed, seed level. I think over the next 1 to 2 months that might calm down, but I mean the valuations we saw November this time last year were at least 2 to 3x higher than what we're seeing today.
I think the problem with the entire venture industry is it's premised on the idea of number go up. And when number doesn't go up, specifically anti-dilution provisions, it's a very, very bad situation to be in. So it's such that down rounds, I think, in the NFT space in particular, are less likely than no rounds, just is too much work and headache. Which ties into the last part of your question. If it's a choice between doing some new investment at a down round and all the diligence you're going to have to do on the founder to get comfortable with that as a company, assuming you're not currently an investor, versus focusing on your existing portfolio and thinking about who's going to win, who's not, and doubling down on your time and energy, and maybe in some cases follow-on financing. I know what I think is the better use of time in my perspective. So I think time and capital are getting very scarce. Even those with capital, I think, need to, it hasn't so much hit valuations at seed and particularly seed, because there's only so much you can dilute a founder, like 20% dilution. But I think it really, if you take a Bayesian approach to it, it should affect your likelihood of the next round finding financing, right? So like I think about it like if we're backing a new game studio, for example, and it's a $15 million development budget, and you have your standard 3 on, say, 12 type of seed round, I need to be thinking, okay, what are the odds that this company can raise $12 million at a $40 million valuation at cash out minus 6 months? And if the market is stressed, as many macro commentators seem to believe next year will be, I should be discounting the probabilities of that happening and either be ready to commit the 12 million myself if the company is meeting milestones, or rethink the funding model entirely.
Yeah, and I would say, valuations aside, a factor in the decrease in activity has been also operational performance. Specifically in crypto, I think we've come to realize this year that some of these models are inherently not as durable. And specifically when it comes to follow-on or growth financing, it's pretty hard to invest in things when they don't have kind of strong fundamentals and operationally are not up into the right. So that's why I expect to see continuous slowness, especially on the growth side.
One question, when Alex was asking you guys about the things which get you excited over the next months, none of you mentioned DAOs and Metaverse, and I just wanted to ask if there's anything interesting within these categories which you see?
I can answer the DAO part. I spent a good amount of time in DAOs. I've co-founded DAOs. They haven't found product market fit, nor have the infrastructure been built out for them to really be scalable. I think they're a really interesting idea, and there's a lot of power that can be unpacked by it. But to date, like if you look, there's kind of two DAOs, or three kind of primary DAOs that have taken form. There's the on-chain kind of finance DAO that controls governance of MakerDAO, right? But even that, the governance has kind of been pushed off to, it's controlled by a bunch of VCs or early token holders who have an outweighted event. And also there's kind of a lack of voting in general. So even if I own 5%, I can sway an outcome. Then there's investment DAOs, which are just wrapped LLCs. And even those, depending on how big they are starting to get strained, right? Because the number's not going up. And then the other one is the community DAO, where I think is probably the most powerful and they're the easiest because you can align people on a common vision. So if you're looking at like Link's DAO or Kraus House, everyone's in that because they like golf, they like basketball. Versus if you have an investment DAO with 50 people, they all can have different ways on where the DAO should go. And that creates disharmony. And then just kind of a basic behavioral, like economic issue with DAOs is how do you appropriately compensate within the DAO, and that's a big issue that I think has struck investment DAOs is figuring that out, or even looking at sushi DAO, right? Getting a proposal how you compensate the core devs, the core team. Do you sell sushi for that? A lot of those issues haven't been solved, and I think in a bear market those issues are exacerbated. So it's going to be, I think next bull cycle, hopefully in the bear market, people can experiment and play around with that and come up with better incentive mechanisms for DAOs.
Hi, so we've spoken a lot about kind of end user and consumer facing applications of crypto and the blockchain, but what do you think are some blocking factors and where do you think the next big wins are on the enterprise side? Is it metaverse, is it NFTs, or is it traceability, authenticity, and why do you think we're not there yet where we see the large global brands really using Web3 actively?
I'll take the last part of that question. So on enterprise, you know, when I was at JP as the CEO of FX, we had a massive intraday liquidity problem where having intraday settlements using a blockchain would make all the sense in the world. What we quickly discovered through the industry consortia like R3 and other things is the blockchain part was not the hard part. It was tearing out all your back office systems around operations, settlement, liquidity, all of this stuff, and then making it speak to the new system, right? And so I think that's the general problem that exists within the financial institution space. But I think the space has moved quite a bit. At the Goldman conference, I learned one company has done $12 billion of kind of asset issuance on chain, which I found pretty astounding. So for that stuff, I don't think you need the maximal decentralization. I don't think you need the incentive layer. I think you need the standardization of operating on shared systems, and there's a lot of efficiency to be had there. On the metaverse point, without getting into what metaverse means, I think I'm personally quite excited about the kind of NVIDIA thesis around simulation. Everything is going to be simulated, everything in the real world. And there's a lot of enterprise use cases in and around that that we're starting to see where I think to me, the best definition of the metaverse relates to how users feel, which is when they have to ask the question, wait, which reality are you talking about? Because the physical and the digital have gotten so intertwined. And so I think that the TAM of that stuff is ultimately pretty massive beyond crypto speculation around virtual land, for example.
And I would also add that your enterprise point also expands to non-financial institutions who have their end users. I see a lot of opportunity for scalable ways to issue wallets, for example, to your end consumers at scale, to enable them to interact with the blockchain in a safe manner. I think we're waiting a bit on more kind of enduring use cases to attract consumers, but potentially many consumer-facing companies could adopt crypto to offer to their end users.
Yeah. In terms of things that block the UX, I think it's pretty clear that there are some serious advantages to public-private key cryptography, but there still haven't been big like multi-party compute projects and like interesting social recovery projects, things that smooth the user experience for losing keys or losing control of a specific piece of code or something like that. Those are on the horizon. I know account abstraction, everybody's talking about, is going to be the next big meme for Ethereum. I think it probably will be. So I don't know. I think the current UX is still really far out, both for institutions and for end users. But maybe I live in a bubble, you know. I just like, it seems inevitable to me, you know. I hear the dev calls. I talk to the portcos. It just feels like a matter of time.
Yeah. And I think on the consumer side, to date, you can't really point to where's the value. Like, why should I put the efforts and resources into this? Obviously, you have someone like Facebook or Meta who's put a ton of money into the future and on their bet on that. And to date, it hasn't really proven any or hasn't shown on the balance sheet. And when you have a public company, it's pretty hard to justify putting significant resources, something that might, in the short term, cannibalize your bottom line. And there's no clear to say like, hey, this is the ROI on this, or this is what we can expect improvement on customer engagement. I think you're seeing a lot of experimentation. And if those kind of find product market fit and become successful, I think it's kind of like a snowball that becomes an avalanche, but we're still pretty early on in that stage.
Hi, this is Michael. I heard some interesting comments, and maybe I would like to ask the panel to comment. Is the line between traditional VCs, I mean traditional in Web 2 and Web 3 now blurring? And how do you see the evolution of the Web 3 VCs or investors? Do you see that you all become the same common family, or you see further diversification of the Web 3 type of investment into different type of segments, DeFi, you know, metaverse or gaming or something else? I mean, if you can share your thoughts, this would be awesome as a conclusion, maybe.
I think it depends on the sector. So for gaming, for example, I view the Web 2 and Web 3 side really converging from a skill set and analysis standpoint. You know, like you heard Hilmar talk about this morning, like how the hardest part around sustainability, that's like a Web 2 problem fundamentally. You know, some of the best types of blockchain games, in my opinion, are things like the Chinese simulation life games, or SLGs, that, you know, things like Kings of Avalon that have grossed, you know, $4 billion lifetime, and are very much the same types of questions around open economy dynamics. And so, you know, people like that are going to be the ones, in my view, to, you know, successfully incorporate Web 3 as an incentive layer in those types of games, while building that core sustainable engagement loop. I think the answer is probably different for some of the type, like the kind of core crypto protocol stuff, where specialization is more important than ever. Maybe one of you guys can talk about that.
You know, I'm on the crypto team, right, at A16Z, but we do collaborate with the games team who's here. They've been doing a lot of crypto stuff, you know, specifically in games, obviously. Same with other verticals. I think it still remains to be the case that being deep in crypto makes a better and bigger difference than being deep in whatever second specialization area there is. But if we really do believe the thesis that adding crypto is adding one of the next important interoperability layers of the internet, then I think it will spread to other verticals, and we'll see different types of specialists and different kinds of generalists playing in different spaces. So it's a little bit hard to see exactly how it plays out, but we're seeing the early signs. Games seems like it does require a special skill set. DeFi, not as clear. I think that's blended a little bit more. Core crypto infrastructure, of course, remains clearly crypto. And I think but I haven't, for example, I haven't seen like a big crossover yet between like DAOs, DAO tooling, and like consumer. But I'm sure we will.
I believe we'll see a variety of successful strategies. At Excel, actually the generalist approach has served us well, especially as we invest more in the application layer of crypto. We've seen a lot of power in our ability to draw from learnings a lot of our Web2 gaming investments, our investments in IT infrastructure, developer tools, security. So have kind of straddling that expertise on both sides enables us to hopefully take the right decisions in Web3.